Hi, my name is Peter Haines. Welcome to our event, SM&CR Lessons Learnt and Next Steps. What we will be covering is, first of all, the lessons learnt, where I will be standing in for Stuart Holman, our Managing Director of CCL Compliance Limited, in his absence. Then I will be doing my own area, which is conduct training and the lessons learnt. We'll then move on to my colleague Carwyn Evans, another Managing Director, CCL Compliance Limited, and he'll talk about the flight path to 9th of December 2020. Then my CCL Academy colleague Nigel Sydenham will talk about non-financial misconduct. And we will then have Martin Mitchell, another CCL Academy colleague, who will talk about conduct training going forward. So I will start in Stuart's absence by talking about lessons learnt. And first of all, just getting started, what we've seen is in terms of documenting decisions and reasons, it's so key actually to start any project, but certainly the SM&CR project, by making sure that we understand and document how each aspect of SM&CR applies to the firm. Those firms that have implemented the regime well documented the reasons why they propose to take each action. They put themselves therefore in a good position to be able to explain why they did what they did when challenged. And this challenge could come from the FCA itself, from auditors, from incoming senior management function holders or SMFs. So as a result, they're also better placed to avoid making ill-advised changes in the future, simply because they won't have forgotten why they did things in a certain way in the first place. The other thing that we saw was good around implementation was what we call a walk-through scenario analysis. So identifying pitfalls early. Firms that actually spent the time thinking through each aspect of SM&CR and how it might affect them tended to be more successful at identifying the areas of challenge, including sometimes identifying potential pitfalls in their original plans, which led to an earlier understanding of the practicalities of living with SM&CR. Conversely, firms that didn't take the time to walk through every aspect of the implementation and how it applied to them before starting to put everything into place, they sometimes faced challenges when issues started to become apparent. We also saw what good looks like in terms of stakeholder identification. So firms that prepared well identified the various stakeholders in advance in each firm who needed to be involved, who they were, to keep informed as things developed, and sometimes identifying some unlikely stakeholders, such as people just below the SMF level who needed to be kept on side with the decisions being made at senior management level. So for example, one core SM&CR firm's plans were thrown into confusion at a late stage when an important member of the firm, who happened to be a head of department but not an SMF originally, asserted that the firm should become an enhanced firm. The reason for that was that that person would then get an SMF position that they felt appropriate to their position in the firm. Now, why anybody would want an SMF position when they don't necessarily have to have one is beyond me. But that stakeholder identification is nevertheless important. We also saw responsibilities maps as being quite an important part of the regime. Now, you might be thinking, hang on, that's only a regulatory obligation for enhanced firms. But a lot of core firms also prepared a form of responsibilities map as a starting point. This helps to get the overall structure agreed, and it tended, where it was done, even if it wasn't technically required, to end up with a more consistent and appropriate arrangement for implementation of the regime. In other words, start from the top down and you're more likely to see the overall picture. The other aspect of getting started was planning for business as usual, so living in the house you build. So firms that took time to think through exactly how the changes they were planning to adopt would work out in practice, those firms tended to find that they had more efficient and scalable arrangements which were no more complex than they needed to be, once implemented. An unfinished business. So governance, getting it right. SM&CR presented all firms with an opportunity to effectively conduct an MOT of their governance arrangements. Some firms use this as an opportunity proactively to address some lurking deficiencies that might have been allowed to remain, maybe known but not acknowledged. So, for example, some UK subsidiaries of overseas firms were essentially being run as branches by the parent organisation. So some firms addressed these issues up front. In truth, others glossed over them. If they did gloss over them, these things will come back to haunt them. We also, under governance, looked at the scope of the required functions. And maybe, are they as narrow as some people assumed? For some firms, when they considered what was and was not inherent within, for example, the role of the compliance officer or the MLRO required functions, some senior managers erroneously assumed that anything to do with the FCA or anti-money laundering was automatically the responsibility of the compliance officer or the MLRO. That is a false assumption, and firms who got that right at the beginning got the implementation of the whole regime achieved in a much better and efficient way. And partner functions. With corporate partnerships, the SMR gave limited liability partnerships the opportunity to tidy up their partner function approvals. There was much clearer guidance given by the FCA in, I'm going to get technical now, in SUP 10C518G, and this discusses partners without influence. Although conversely, it's hard to understand how the automatic conversion by the FCA of corporate members to the SMF 27 really aids senior management responsibility. And in terms of prescribed responsibilities, one of the very, very important areas of implementation, sharing and dividing. Not all firms who insisted on sharing those prescribed responsibilities have necessarily been able to substantiate why this is justified. And there's also the likelihood that some sharing of responsibilities will come back to bite individual senior managers when they are held responsible for failures by fellow SMFs with whom they shared specific prescribed responsibilities. Also on governance, there's the key area of duty of responsibility. And it's not all new. Some SMFs were fairly philosophical and took the view, we've got this new duty of responsibility, but actually it's not all that new. And they'd already considered themselves on the hook to the FCA and the PRA if necessary. Others seem to think this whole concept of responsibility was somehow new. In practice, all that's new is that the FCA has a more efficient power to take action where they believe a senior manager has failed to perform his or her role properly. The standard itself is not new. Reasonable steps existed in the previous conduct rules for senior managers, so nothing new, just the approach from the FCA. And risk management framework. It's always a good starting point to look at risk. Firms who had a good risk management framework, a risk management register, risk map, other good risk management arrangements, with individual senior managers responsible for each risk, found the preparation of statements of responsibility far more straightforward. Firms that had not documented their risks properly and either had not really identified all of their risks or had allocated risks too widely faced more challenges trying to put together a collection of statements of responsibilities that showed how the firm was run. More on statements of responsibilities, looking at reporting lines. Firms that already had clear reporting lines, which reflected how the firm actually worked in practice, tended to find the preparation of each individual SOR far more straightforward than firms that either didn't have clear or documented reporting lines, or if they didn't actually follow them in practice. Now, matrix management for larger firms has been a real challenge here. Again, if it was clear before SM&CR, the whole project was made far simpler in its implementation. And Staying on statements of responsibilities, let's focus on coordination and consistency. And it's a question here of spinning the plates. In firms of any size, it was challenging to coordinate the task of preparing all of those statements of responsibilities. What we found was in some firms, a number of SORs were completed quickly, sometimes at the expense of accuracy, but others took more time to prepare, such that previously agreed SORs needed therefore to be amended. Most SORs can only really be assessed when compared with all others for the firm. And note the point I made earlier about the responsibilities map, even if we didn't, as core firms, necessarily need one. So if we can compare SORs against each other and against the overriding map, this enables gaps and overlaps to be clearly seen and addressed. And again, on statement of responsibilities, what about job descriptions? What's the difference between a job description and a statement of responsibility? Well, most firms appreciated that job descriptions weren't the same as SORs, but that they were both a good starting point. So job descriptions do need to be consistent with the SORs, and they still do fulfill a useful purpose post-SM&CR. However, some firms have struggled to distinguish between, I guess, the task-related nature of job descriptions into the wider description of responsibility under the SOR. So what does good look like in terms of statement of responsibilities? If Goldilocks were writing an SOR, it would be not too short, not too long, but just right. Some initial drafts of SORs were too short and missed whole aspects of the firm's operations for which somebody has to be responsible. But some were too long and left it unclear as to what they actually covered. So, as the purpose of an SOR is to tell the FCA who is responsible for the area in which a failure occurred, then some of the shortest and broadest SORs might be considered the best as far as the regulator is concerned. But clarity is of utmost importance. We have other challenges which we've seen. So criminal records and regulatory references. Regulatory references has been a problem area for quite some time, well before the implementation of SM&CR. What SM&CR did was to impose some more specific and robust requirements over an existing obligation. The challenge on criminal records sometimes has been to undertake criminal records checks potentially across multiple jurisdictions. But that has posed fewer problems to firms than the need to identify previous employers and seek regulatory references from them, all the while trying to keep recruitment on track. We've already seen, as is expected with references, firms seeking to game the system by trying to stop key staff departing and setting up in competition through what could be argued to be unfounded adverse references. We've also seen individuals seeking to use honest references provided in good faith as grounds for legal action. This one will run and run. We've also seen the challenge of the scope of the client dealing certification function. So you have purely administrative people who would not need to be certified in that role, versus people requiring a significant amount of skill in dealing with customers, versus those who genuinely pose significant harm to the firm, its customers or the markets. So the point at which an individual's role stops being a supporting and an administrative one and comes within the client dealing certification function has posed certain problems for firms. And conduct training, there will be more about this later on, but it's been so important to make it relevant. Not all firms have taken on board the FCA's oft-repeated warning that conduct training needs to explain to conduct rules staff what good and bad conduct looks like in the context of their role within their firm. What we've seen is the FCA's stocktake report in August of last year, which made it very, very clear that not only are the conduct rules a critical foundation of a firm's culture, but also that conduct rules training has to be taken seriously. So what they don't want to see is a senior manager saying, Okay guys, gals, it's time for your conduct rules training, so gather round. Okay, here goes. You must act with integrity, due skill, care and diligence. You must be open with the regulator. You must treat your customers fairly and act in accordance with standards of market conduct. Any questions? No? Good. Thanks. Off we go, back to your desks. That simply isn't good enough, but we'll talk more about that later on. Moving on to another challenge, fitness and propriety assessments. This has been quite a challenge for firms big or small. In many smaller firms, or any firm where there's a single dominant CEO, often maybe the founding partner of the firm, finding anybody with a seniority to undertake the fitness and propriety assessment of this person has proved often very challenging, sometimes ending up with self-assessment as the only practical option, which is not exactly satisfactory. In larger firms, the challenge is different, and it's that of getting consistency of approach across the firm, where those F&P assessments are performed by various different managers. In some cases, firms have set up fitness and propriety committees to assess consistency and, very importantly, to address individual cases where the decision is less than straightforward. And this has been a useful approach adopted by a number of different firms. Another challenge is conduct breach reporting. So lots of stakeholders in firms of any size have put in place reporting lines and controls to ensure that the right people get the right information about conduct breach reporting at the right time, bearing in mind obligations under GDPR. And this has itself proved challenging. So some firms have set up committees, in some cases as subcommittees of the board, to adjudicate on conduct rule breaches. And remember, of course, conduct rule breaches have to be notified to the FCA. If it's a conduct breach by an SMF, it has to be as soon as practicable and in any case within 7 days. And for conduct rule staff members, it has to go into the annual report, the first one of which will be due in October later this year. So in conclusion, it's been an interesting challenge to implement SM&CR in firms of all sizes. One thing you should remember, please don't underestimate the likelihood of the FCA conducting thematic reviews of implementation in the near future. They could be coming to your firm to see how you've put SM&CR in place.